What's up, guys? My name is Mike Sharp. This is Sharp Investing, and today I'm going to talk about Kaspi, which I bought a few months ago at $80.65. I did expect the stock to go lower at that point because it was in a downtrend, and I usually think that the trend will continue until it turns around. It looks like it may have turned around now, but we will see. Sometimes you get false breakouts to the upside. I think it's trading about 90 right now, so it's up a little bit since I bought it. But this thesis is probably still valid. Okay, so I think that Kaspi is maybe one of the best moats, maybe one of the best businesses that I've ever looked at. It is a phenomenal company with an absolutely, like, as far as I can tell, it's an impenetrable wall around it. It has a phenomenal CEO, fantastic CEO that I love. And it is also in one of the least appetizing jurisdictions for Western investors, which is Kazakhstan. I encourage you to listen to the thesis here, even if you got turned off by the country. Now, emerging markets, frontier markets, they always have their challenges, but I think there's some reasons why. There's a lot of reasons why I bought this company anyway. I do think it's going to return quite a bit to shareholders in the future. Okay, so if you don't know the business, Kaspi is a super app in Kazakhstan. They have payments, they have marketplace, and they have fintech. It all works together in a sort of a closed loop environment where they don't actually let anybody else in. Nobody else can play in this walled garden that they've created, and there's a lot of synergies. There's flywheel, there's all the financial jargon terms in it that you could want. They have 15 million users in a country of 20.5 million people, so 75% of the country uses this thing on a regular basis, this app on a regular basis. And if you're looking at, I think it's the second most engaged app in the world behind WeChat. And basically, if you want to live in Kazakhstan, you need to have this app to function because they use it to purchase everything. Basically whatever you need to do, you have to have it. So also keep in mind that 30% of the population in Kazakhstan is under 15. So that's like 6 million people. So we have 15 million users on 20 million population. A lot of those people are kids that probably don't have this app. So basically almost every adult will have this app and be using it on a monthly and almost all on a daily basis. So to get into it, the moat is the thing, right? So I'm going to read a little excerpt here that will help explain it, and then I'll talk about it afterwards. But Kaspi has built a super app that integrates banking and fintech, a marketplace, and a payment solution into a single ecosystem. When a customer uses their Kaspi debit card or the Kaspi QR code on their mobile phone to make a payment to a merchant on the Kaspi Pay network, the entire transaction happens within Kaspi's own system. The funds move directly from the customer's account to the merchant's account, both of which are part of the Kaspi's ecosystem. So if you're in a Western country like me, you go take your phone, you make a payment to store. That's going to go through a whole slew of different companies. You're going to have to use Visa or MasterCard usually, Stripe or Adyen or one of the other payment processors and gateways gets a cut of that too. And then there's banks involved on both sides of the transaction and merchant acquirers. There's actually the point of sale system. That's a lot of the time a different company. And each one of these companies takes a rake and means less money gets to the merchant in the end. In Kaspi, all of that stuff is all Kaspi. There's nobody else involved, right? So you take money out of your Kaspi bank account, pay the merchant, it goes right to them. Visa, MasterCard, dead, right? They've been disintermediated along with all those other companies, right? So Kaspi has a monopoly on the whole process, right? And if you look at that, like when I heard once, imagine you were given $50 billion and you got to use that to compete with XYZ company. could you actually compete with them? If you gave me 50 billion and even said you don't even need to be profitable, you just have to get into Kazakhstan, into the payments world, or into basically payments is the key thing here. You have to break into there. Like, I don't even think I could do it, right? This is just, it's a winner take all market, and they've won and they've taken it all, right? There are still other banks, but really the rest of the system, there are actually other marketplace like e-commerce sites as well, but they're quickly eating that whole market share as well. So I think there's basically, this is just a pretty impenetrable moat. So to explain the sort of network moat that they have, let's run through it, right? So each customer in the country has the app. It doesn't cost them anything to have that. So they already have that. So all the merchants know they need to have the app. They need to be able to take Kaspi payments, right? So all the merchants have it, right? So now all the consumers, all the merchants have it, and they're all making all these transactions on it, which means Kaspi has way more data than anybody else in terms of every single person's purchasing and spending and income and borrowing habits. And they can use that on their marketplace to sort of target people better. They can advertise better. The merchants on the e-commerce site get access to better targeting when they place ads, so they get a better return on their money when they advertise there. The merchants are able to sell more. They're able to target on that site really well. And then on the other side, on the fintech side, they also have all the data in order to lend to these customers. So they lend to the merchants. They also do consumer lending, and they know everybody's habits, right? So they can target the lending very precisely. And this has led to world-class NPLs, right? Very low non-performing loan levels, which, that's really hard to compete with when you're a traditional bricks and mortar bank and you don't have all the data available to lend, right? So they're able to lend more efficiently, and it just keeps looping, right? People use the app more, they get more data. It's the flywheel. So phenomenal business, right? Pretty easy to see how good it is. Now I'll go into some of the financial stuff later, but you'll see it's just leading to high margins and super high growth rates as well. But if I go back just a step, I'll talk about sort of why I bought this originally. I thought there was a few sort of short-term problems that were going to be reconciled at some point pretty soon, like maybe in a year or longer. And if you've seen my other videos, you know that I love situations where the market takes a negative situation and they price the stock as if that temporary situation is permanent. And I think that's what's happened here. So basically I bought the stock at about 8 times PE, and with a forward EPS growth rate of about estimating, let's say 20% to be conservative, that means the forward PEG ratio is below 5, right? So I have a pretty good margin of safety there in terms of the price I'm paying for this business. And the reason is, like, we've had some, like I said, short-term problems. One, they cut the dividend last year, and this is a temporary cut, and they used it to fund the purchase of a company called Hepsiburada, which is an e-commerce site in Turkey, and that's their big growth play. So basically they stopped paying out cash flow as dividends. Mind you, they used to pay 75%. They had a 75% payout ratio because they had nothing to do with the cash before, so they just pay it out to owners. I expect that to come back, and they actually made an announcement saying it's going to come back. But when I bought it, there was no plan of when it was going to come back, but I just thought, okay, well, the stock price has come down based on the dividend cut because dividend investors just sell, and that's going to reverse at some point, right? They have been saying this Hepsiburada investment cycle is pretty short. They'll be done like within the next 6 months. Well, so 4 months now because it's August. And then they'll be back to having their normal huge cash flows that are just basically free to do whatever they want with. So short-term dividend cut, that's a great one to fade on a company like this. They also have growth headwinds that are created. They're mostly macro and government related. So the government created some new rules around mobile phone purchases, and I'll let you look into that. But basically, it slowed mobile phone purchases down in the short term while everybody readjusts to the new rules. But probably everyone's going to buy mobile phones in the future like they have in the past. So that is another short-term one. And there are also interest rate hikes that have come in that, that's designed to slow the economy down. It reduces margins on lending, which I'll show you when we get to the actual financials of the three segments. So, but they said that'll reverse when rates come down, and they probably will. Like, as you can see here, they're close to their 10-year highs, around 17%, and interest rates just fluctuate as financial situations change. So that headwind is probably going to turn into a tailwind at some point. There was also a short report, and again, I'll let you look into this, but as far as I can tell, it's basically just, it's mostly just Russia fear, right? Like saying, they're illegally lending, opening accounts for Russians, but the truth is Russians can open accounts with Kaspi. There's a lot of Russians in Kazakhstan. It's only if you circumvent sanctions rules with certain sanctioned people, right? So anyway, take a look at it. I think it was a short-term blip here based on this short report, which doesn't seem like it has a lot of legs to it. Anyway, that's my opinion. Have your own, read it, take a look. Okay, so I want to talk about the CEO. One thing I love is CEOs that are, they're just great executors and they have great vision. And I think Michael Lomtadze is one of these people. He is, like, if you listen to him, I actually encourage you to listen to the business breakdowns with him on it. He talks about the company a lot, and it gives you a really good idea of how the business was built. And I think it's required listening if you're interested in this company. But Michael, he's basically, to me, he's just a no BS executor. He's a ruthless rationalist, and he's just saying, okay, what's the best thing we can do? Let's do that. And his history of execution shows that he actually does what he sets out to do, right? So anyway, that's sort of is very qualitative, but also if you want it on the quantitative side, he owns 22% of this business. He's a co-founder, and the other co-founder, Vyacheslav Kim, I think his name is, owns 21%. So as an equity holder, I am on the same team as those two, and I like that. And Michael does talk frequently in the earnings calls. He says, you know what, we're going to do what's best for shareholders. I'm a big shareholder too, so I want to be doing what's best for shareholders, right? So it's nice to be on the same team as somebody who has that much skin in the game. Okay, so love Michael, CEO. If you're watching this, thanks so much for watching. Probably not, but doing a great job. One of the sort of identities that he's built into the business is this is a spawner type business with large NPS scores, right? So what do I mean by, if you don't know what NPS is, a net promoter score, right? So if I ask, if somebody talks to me about a Tesla a couple of years ago, and if somebody says, hey, how's the car? I'm like, man, this is the best car. It's so great. Super fast, quiet, everything's great, easy to, charging is pretty quick. I just plug it in at home. Everything's great. I love it. Sound system's great. And then they go, haha, Tesla's lame. You're a loser. I go, I don't care. The thing's awesome. Right. But that's me promoting the car, right? There's no, the company doesn't have to spend advertising dollars. And I'm just like, man, this thing's fantastic. Tesla has a really high net promoter score. Amazon did. I don't know if it still does. Apple did. I don't know if it still does. But these companies where the customers really love the business and the products, right? This is really a great backbone for a business. And that's basically what Apple was built on. Steve Jobs just said, I just want to build great products that people love, right? And he did that, and they built this empire based on it. Tim Cook is trying to destroy the empire. I think he'll succeed, but enough about Apple. Kaspi has this type of really high net promoter score. And part of their culture is that if they build a product, one single product with one feature, then they test it and they send it to their customers, and the customers give them feedback. And if they don't get high scores, they ask, what could we improve? What could we make better? And if they don't get a high net promoter score, they kill it, right? So they don't want any subpar products sullying their reputation and their ecosystem, right? So this is very strong principles, very, it's built on not just making money, making great products that people love, right? And so the biggest example of that is he tells a story about they had credit cards previously. I don't think they have them now. And they got a negative net promoter score on these, right? So they said, this isn't like making our customers' lives better, and we're going to kill it. Even though it was a third of their revenue at that point, they killed this product because it was people were giving it bad reviews. So now it's just like, it's a backbone piece to the business. And if they do get a high, remember I said that they take out one product, if they get a high score on that product, then they start adding features, right? So it's very simple. Rather than building a whole suite of everything, they just make it very simple, get people used to the product, and then they add to it, right? So some of the examples of this high NPS, did I say spawner too? So they have this spawner sort of personality. If you're familiar with Manish Pavarai's term, basically companies that continue to build new products and new revenue streams, right? So recently they built Kaspi Travel. They've started doing grocery. They've done it really well. They have this restaurant app where you can pay with the QR code and don't have to ask for the bill and all this stuff. They've also added ads for the merchants online on the e-commerce, which, by the way, is a massive potential growth lever. Most of these big businesses, Meta, Google, Baba, these are all built on advertising, right? And they have not milked that part of the ecosystem yet. So that's actually still in early stage growth mode, right? So if you're wondering about growth, that's a big one. They've also got B2B payments now, right? If he talks about if Coke comes and delivers Coke to a store, they can pay within the Kaspi system, a B2B payment system in there for merchants as well. So that could also be pretty huge. But anyway, the company is built with, let's build great products and let's keep building new great verticals that people love, right? So if we go to the growth side, wait one sec here. So if we look at the growth side, people worry about, the first worry that everyone has is, well, there are 15 million people out of 20 million people. Where's the growth going to come from? And the CEO says, well, basically the 15 million people is the foundation for the growth, right? We keep adding products. We're really good at it. And most of the products they have are nowhere near saturation. So I think the fear around this company being slowing down considerably on the growth side are not valid. Maybe in certain segments, but overall, not even close, I don't think, to full saturation. So maybe we'll talk about, we're going to talk about margins here. Okay, so let's look at some of the financial statements, and we'll look at, I'll look at the report actually. You can see that we'll start with payments. So payments is the most profitable part of the business, huge margins, but it is starting to slow. So we talked about slowing growth. This is one of the areas where it is slowing down, and there's only a certain amount of payments that can happen in a country, right? And when you are the market, eventually it's going to slow down to a level of GDP plus, let's say GDP plus, right? So we're going to trend in that direction. I still don't think it's anytime soon, but you can see that the number of transactions year over year is up 14%, which is, it's not huge compared to a lot of their other growth rates. Total payment volume is up 21% year over year, which is nice, but that segment is slowing down. If we look at the revenue and the income for the payment side, you can see there is some operating leverage here. We have a growth rate of 16% on the revenue side, up to 161 billion, and earnings are up 19%. So there is operating leverage on this side. And you can see massive margins too, right? This is like 66% margins on payments. So extremely profitable, even though their take rate is only 1.1%. A lot of their payments are actually free. I think if you use the Kaspi QR code, it doesn't actually cost the merchant anything. So actually, I need to go back to the network, to the Moat situation. This is actually a very cost-effective product for merchants too. Like you're paying 1.1% of transactions. A lot of them are free. In the developed world, like you're paying probably at least 3% to use Visa or MasterCard, right? That's a huge rake that they're taking just because they have a monopoly. And these guys have, another reason why, the customers should love them, right? They're making life cheaper for them, right? So, anyway, really great. The bottom line is great product, great service. Okay, so payments probably going to slow down, still some operating leverage, but not really the growth engine anymore. Marketplace, this is a massive growth driver. So I think I read 16% of retail commerce in Kazakhstan is e-commerce, right? So still a huge opportunity for growth there. And right now they're growing marketplace purchases up 35% year over year. And gross GMV is down, whereas the growth rates are a lot slower in certain segments, just because, again, we go back to this, these short-term headwinds. The macro situation has meant that people are buying fewer cars, and you can actually buy cars on Marketplace, and these are huge ticket items. So when people buy fewer cars because of the macro situation, it really impacts the gross merchandise volume, but the number of transactions doesn't change that much. So I think that the GMV is a bit of a trick here, because eventually those will go back up when interest rates come back down. The GMV will accelerate in the other direction. But if we look at take rates average, let's say 11 to 12%, pretty reasonable. And if we look at the revenue and net income for this segment, you can see that there's actually negative operating leverage here. They're still in growth mode. They're still investing in this area. And you can see that revenue is up 25%, but net income's only up 13% year over year. And this is due to the investment side of it. One day that will reverse when they get close to the size they want to be. But right now, this is just a growth. This is a growth segment, and we expect it to be a lot bigger in the future. I should also mention there's 70% of the e-commerce market currently, so close to a winner-take-all situation there. If we look at fintech, right? So fintech, the breakdown is business loans, consumer loans, general loans, I guess, car finance, and buy now, pay later. That's the fintech side. And because interest rates are up, this segment has taken a bit of a hit in terms of profitability this quarter. And they do say that's expected. And it will turn into, it'll turn into a tailwind when rates come down, right? So, but we see that the revenue year over year is 21% in the first quarter, and the profit is up only 8%. So that's due to the rates that I was talking about. The upside to higher rates for them is that there's actually more money that's brought into the system on the deposit side, right? So they're seeing a big growth in deposits, which they say actually is a long-term driver of additional growth, because that's more money inside that sort of walled garden we're talking about, right? That will eventually turn into marketplace transactions. It'll eventually allow them to lend more, because actually at quite a high loan to deposit ratio right now. I can't remember the number, but it's in the 90s. And so there's not a lot of room left to loan. But as deposits come in, that increases the ceiling on the loan side. And the payment side as well, actually, because it's more money in the system to make purchases with. So you can see these are very, I don't know if I talked about margins there, but you can see that the fintech margins are about 20% right now. They've dropped from 25%. So very, very profitable. Marketplace is more like 40% margins, and payments are 66% margins. These are very high margin businesses, and the company has a history of making sure that they make money on their new ventures, right? So as Michael says in his interview, he says, well, we were never blessed with being able to have access to financial markets early on. So we learned that we just have to make money right away. So they tend to be profitable in these new verticals within 12 months, which is really fast when we're talking about a tech business. Most, you can look in the US market, there's these companies that lose money for years and years because they can just pull money out of the stock market at 30 times sales to fund growth, and then they don't have to be profitable for 10 years because exuberant investors are pouring money into them. I should mention here, just in terms of financial markets, they did list in London in 2020 and then moved the listing to the NASDAQ in 2024 because the liquidity was a lot better on the NASDAQ. So now it's not quite the same. They do have access to more liquidity now. But it's trading at 9 times earnings. You probably don't want to do that, right? Maybe if they got an exuberant moment where the stock was trading at 20 times, they could pull some money out and fund some growth initiatives. But honestly, they don't even need to, right? This is such a cash generative business. They're running at about a $2 billion net income rate right now. And, they don't really have many places to put it. So where do they put it? They put it into Turkey. I don't know if I talked about Turkey already, but I will talk about it again. So Turkey, they have just bought a company called Hepsi Barada, which is the number 2 player in e-commerce in Turkey. They also bought a company called Rabobank. I think that's how you pronounce it. Basically a shell of a bank. They don't actually have any customers, but they have the banking licenses and stuff so that they can enter the Turkish market and try and replicate the success they've had in Kazakhstan. Now, why is this significant? Well, they've hit their growth targets in terms of customers in Kazakhstan, but their overall growth goal is to get to 100 million customers over time, right? So that would be a 7 time. They have to 7x their customer base somehow, right? Turkey is a great option for that. They say there's a lot of similarities between Turkey and Kazakhstan, and they think that they can have a successful go at it in Turkey as well. I believe them. I'm sure they do their due diligence before making these purchases. But even if they don't, basically it's just a few months worth of cash flow that they've invested to buy Hepsi and Rabobank and have a go of it, right? So now I should say that this isn't a short-term upside play, right? If this is going to work, it's probably going to take at least 3 to 5 years to show it's materially working. So for now, I'm focusing on the Kazakhstan side, just making sure there's enough upside there for me to make the return I'm looking for. But this is the home run swing. If this works, this stock can be a 10x or more, right? Because you're expanding your customer base massively, and I believe the GDP per capita in Turkey is higher than Kazakhstan as well. They do operate in Uzbekistan and I forget the other country, but they're very small operations there. They don't move the needle at all. But last word on Hepsi is that if it's not really going to impact the financial statements, right? So they have about $2 billion in revenue. They lose a little bit of money. It's a little bit positive on the EBITDA side, but it's nowhere. It's just a drop in the bucket compared to the company's $2 billion in net income in Kazakhstan. So not a huge amount of risk there, and not a huge amount of upside in the short term there either. Okay, so what else do we want to talk about? Why is it down? Well, I think I mentioned this. It's down because interest rates are up. That puts pressure on parts of the business. Will turn into a tailwind at some point. The smartphone headwind, the regulatory changes have impacted their sales. E-commerce is obviously in big part built on mobile purchases. That's a huge chunk of it. And the short report and the dividend cut. These are all short-term headwinds, I think, that will all go away. Okay, let's talk about risks. So how do I lose at this? So I'll go into how do I win at this after, but how do I lose at this? Obviously, Kazakhstan is a question mark because I don't know the country that well. I've done research on it. It looks like it's not like from Borat. I think Borat was filmed in like Romania or something. It's actually like a modern sort of nice looking country in the major cities. It's growing pretty fast. The GDP is up, I think averages over 4% for the past 10 years. But it is very resource heavy country, right? So if oil goes down, they have huge oil deposits, uranium deposits, a lot of base metals, I think. But basically oil is the big one, right? So you've seen oil crashes over the last, and it really affects Kazakhstan. So in terms of recession risk and people running away from the country and pulling their money out of Kazakh stocks, yeah, if we have an oil crash to 40 bucks, there's going to be fallout from that. It's going to hurt Kaspi's earnings, and it's going to people are going to run away from this stock and any other stock that's in the country in the short term. So it can have a short-term crash potential, but keep in mind that's not a business crash. That is a market crash, which I think they can actually turn into a positive, which I'll talk about on the positive side. But just know it's cyclical. I live in Canada. I know when oil is down, it affects everything here. It'll be even more in Kazakhstan. So global recession, not just Kazakhstan based. If we have a global financial problem, stock markets go down, people are going to sell this stuff first. Nobody wants emerging market stocks. Well, this is a frontier market, right? That's even lower down the list than emerging markets. So, be prepared. People might just unload this stuff if there's a real problem. Again, I think short term. So inflation and currency, very high historical inflation rate. So that's a real risk, which leads to the currency depreciation. Now, I've used a 6% average expectation of depreciation in the future in my DCF, which I'll show in a minute. And, I think we can expect that will keep going. But just know if the currency depreciates by 25%, the stock's going to get smoked. But historically, it looks like they've managed it pretty well, given the inflation environment. Okay, so the other risk is there's political risks, which I'm not equipped to talk about. It's a country that borders Russia and China, which are not the favorite countries of Westerners at the moment. So there's going to be, and they're basically in bed with those countries too, because they have to get along with their huge neighbors, right? So just keep in mind that this is not a like investing in a European country or something. There are political risks, and I don't know what they are, but they're there. I do think the risk of owning a stock in the country might be lower than China. Anybody else who's owned Chinese stocks knows that the government can come in and basically and they made Jack Ma disappear. They change the rules all the time. They tell you what you have to spend your money on. And I don't see evidence of that in Kazakhstan. So it's not an interfering government, but I'm sure that there are relationships between the government and this company, because this company is by far the biggest and most successful business in the country, right? So I'm sure there's a lot of intermingling there. So that said, let's go to the upside. So how do I win at this, right? So I think this is a capital return play. So why do I say that? So if we go to actually I'll talk about it first, but so I think this is going to be to get away from all of the political and currency stuff. I think and trying to expect, maybe I'll get a higher multiple here. like I don't want to expect that I get a higher multiple from this stock. Right now it's trading at 8.8 PE, and I don't want to expect more than that because I think that might be a fool's errand, right? We've seen I've held Chinese stocks. They just stay there. They seem like they're undervalued and they just stay undervalued. I've owned Russian stocks. I owned Gazprom before the war, and that stayed at 3 times earnings. Phenomenal company, just kicking off money left and right, growth, and it stayed at 3 times earnings, right? So this thing can stay at 8.8. It can go to 5, and it might go up to 10. You might get a moment when it goes up to 20, and if it does, I'll probably sell a bunch. But I don't think that I cannot expect a Western multiple on this company. So maybe this PE ratio is fair here, and that brings me to capital returns, right? So the company previously, like I said, they kicked out 75% of earnings as dividends, right? So if we look at that now, they're kind of running at a $12 EPS rate currently. If they go back to 75% payout ratio, that's a $9 dividend. If they go to 65%, which I think is, probably more realistic, that would be a $7.80 dividend. So you're looking at an 8 to 10% dividend on today's $90 stock price. Yeah, that's fine. That's okay. But I think that if we look back, when they were actually paying the dividend, the stock price was higher. And I think that dividend investors will come down and increase the price of the stock because behind that dividend, there's also a huge growth rate. Like you have a 20% growth rate each year on that dividend minus the currency depreciation. So let's say 15%. But you have an increasing dividend that's pretty attractive to people with a phenomenal business behind it, right? So like I said before, one of my short-term views was they'll reinstate the dividend, and in the last earnings call, Q2, they said actually it's coming back now. They said that, and I think that's part of the reason the stock jumped up a little bit. The dividend's not fully back yet, but they're saying it's coming back in 2026, right? So I think we're not quite all the way back yet. I think once that lands, once we figure out what the payout ratio is and what the form of that capital return is, then the stock will revalue accordingly, maybe down if it's not that big. But the interesting thing that they said was somebody asked about buybacks, and the CFO said, well, at the current price, we think it's a good deal, right? So we'd look at buybacks at this price, right? So I think that going back to the capital returns thesis here, I think we have a floor under the stock, right? If the price gets too low, they're probably going to start buying a lot of it back, right? So let's just do an example here. Let's say the stock fell to $60. We're down 33% from here. Okay, if you pay out 65% of earnings as a buyback, then that's by 65 to 75%. Then you can buy back 13 to 15% of the float at $60. That's a huge amount of buybacks. If you did it at $90, it's 8 to 10% of the float, right? And so as my friend Yves said, he reminded me that if you do a 10% buyback for 5 years, that means you get 100% return on your stock. And on top of that, you get the growth rate, which is not even factored in there. Just on buybacks alone, you'll get 100% return over 5 years. So buybacks are great. Ideal, those are the best because they're going to reduce the float. Dividends are good because it'll bring dividend investors back. And also I like dividend income. But I think I need to estimate my return based on dividends as opposed to PE expansion. So if we look quickly here at my DCF, now this might be a mess. There might be mistakes in here, and you can call them out if you want, if you see them. I kind of whipped this up pretty quick, but it's just to generally give you an idea of how I'm thinking about this. So it's a giant mess. You can see the growth rate for 2024 and 2025 are really high, 32%, 46%. I'm assuming a very low growth rate going forward. I think this is way too conservative, but I just want to see how it looks when I'm being conservative. So I'm expecting 19% next year, falling all the way to 10%, in 7 years. You can see the total revenue in USD adjusted for my expected exchange rate depreciation of 6% per year. The exchange rate goes from about 540 here to about 1,000 in 10 years. And if I just look, one other thing, the PE ratio that I'm using 8.8 for the next few years because that's what it is currently. And then I'm just going to a 0.5 PEG ratio after that, right? So as the stock goes down to 10, the PE ratio goes down to 5, which I think is probably, I think that's probably conservative given the quality of the business, but let's say that anyway. If you look at here, the IRR, I put CAGR, but it's IRR, it's not great if you don't have the capital return, right? It goes from 13%, you're up to 14.7 in year 3, but that's not great. But if I add in the potential dividends at a 65% payout ratio, we're looking at an IRR of over 20% all the way out to 2029, and 2030 would be 19%. So that's a very healthy return if they return that capital to us at a little bit lower rate than they did previously. So I think it's a good deal. It's not a huge position for me. I think I started it at 7 and a bit percent. It's probably about the same now. But I'm comfortable at that level. I don't want to make it too big because it is in Kazakhstan. There's a lot of things I don't know about the country, and there's probably some unknown risks there. So I'll just keep it at this level and keep an eye on the business as it keeps going. The bottom line for me is this is a capital return play, and Hepsiburada and a potential valuation increase over time as the growth rate comes back, as some of those short-term problems normalize. Those are the bonuses, right? I'm not banking on those, but those are the bonuses. But I'm looking at a 20 to 25% rate of return over the next 3 years. So for me, I'm watching the growth rate and the capital return. And if they keep growing and they keep doing big capital returns and keep executing well, there's no reason for me to change this. I love the idea that it's such an impenetrable business that I can just leave it and forget about it. There is some value in having a business that you just know, okay, they're just going to do great no matter what, because it's such a great business. But I'm not sure how to quantify that. I just know that it helps me sleep at night, which is valuable. Okay, so bottom line here, wonderful business that will be bigger in 3 years just via growth. PE expansion and Hepsi are a bonus. We have a genius CEO as far as I'm concerned, a net promoter score based business, which is they should keep getting bigger and better over time as they keep executing their strategy, which has been working. The upside is 10x or more if Turkey works. If Turkey doesn't work, I still think it's a 3x possibility over 5 years. And downside, I think, is probably short term, it could fall 30 to 50% if you've got an oil meltdown. But I think that's temporary. The real downside is if growth slows down in the business, they're not able to keep the growth rates high, the valuation stays down permanently, then you end up probably with a dead money situation for like 3 years, and then I would have to get out. And again, the political country risk is unknown, so I have to size this properly. Anyway, that's a long video, maybe my longest ever, but if you got here, I do appreciate watching. I would appreciate a thumbs up or a subscribe. But anyway, I will keep an eye on this business, and I'll keep everybody updated as it goes along. Have a great day. Catch you in the next video.